afternoon, everyone, and thank you so much for joining us today. It's going to be a very exciting discussion here. In the world of higher interest rates, geopolitical risk, developing technologies, it's interesting and even challenging to be an investor in emerging market private equity, to say the least. We have an incredible cohort of panelists with us today with different backgrounds that will walk us through these challenges and opportunities, especially when we break them down by region. First off, I do want to talk about those challenges. For a private equity investor, what are the key risks right now? And what are you doing in your role, Elizabeth, as a fundraiser for KKR to overcome these risks?
No, absolutely. Thank you. And perhaps before I start, I should at least provide some framework around what KKR does in emerging markets, because obviously emerging markets are very diverse, not a monolith. And as we think about places like Latin America or Eastern Europe or Asia, it's very different. So KKR's exposure is predominantly in Asia, and that's on a pan-Asian basis. So most of my comments today will probably be reflecting a bit of that geographic bias, and just want to acknowledge that there's clearly other important emerging markets out there. So going back to your question, I think emerging markets have always been challenging because of their inherent volatility, whether that's currency, macroeconomic background, just fluctuations that you would see day to day in these economies. However, I think the challenges and the trends you're seeing right now are around a lot of retrenchment of Western firms investing in places like Asia, for example. And what's interesting is that's not motivated by lack of opportunity. I think that's motivated purely by geopolitical considerations, right? So, and what's interesting is for those investors who are still active, I think it's actually a fantastic time to be investing. You have, by and large, lower valuations, less competition, and you also have a higher growth environment in these emerging markets that you don't necessarily have in the US or Europe, where, particularly in a high interest rate environment, it can be challenging to, I think, have enhanced returns. So, for those who are able to, whether it's for, appetite or, lack of geopolitical constraints, I think it's actually a really good time to invest. And, in my role at KKR and working with a lot of the sovereign wealth funds in the region, you are seeing really forward-leaning behavior towards investing in places like Asia, recognizing the opportunity right now and, the fact that it will be a really good investment environment. So.
Excellent. Thank you, Elizabeth, for those insights. And Taimoor, you kind of look at emerging markets from a different lens at Affirma Capital, $3.5 billion in assets under management. You're looking especially at a global lens, not just from Asia. So walk us a little bit about the risks that you face on a day-to-day basis, or with the conversations that you have when you're doing your investments, and how you're planning to overcome those.
Thank you, Farah, and hi, everyone. So I think, from our perspective, as Sarah mentioned, we managed $3.5 billion. We spun off from Standard Chartered Bank 5 years ago. We did a management buyout of the business. We have a 20-year track record. So from our perspective, what we're doing different isn't very different. We're very, very hands-on portfolio management operators. So for us, in terms of our day-to-day, it hasn't changed a lot. I think what has changed, as Elizabeth alluded to, is how EM is viewed by Western LPs. And I think now the bar has become much higher, perhaps unfairly. If you were able, the last 15 years, you've had effectively a 0% risk-free rate. Now all of a sudden it's 5%. So I think certainly Western LPs are looking at EM with more skepticism. And I would say they should also be looking similar for U.S. and European investments. Though my guess is it's not as they're not looking at it as hard as they are on the EM side. And I think also for us, EM, you have to really look at things very differently. I think it's very difficult to just sort of do a brush around broader EM, what countries are you going into? What are the geopolitical factors? What sectors are you going into? For us, we very much like either to buy very well-known brands that people know, or we like B category volume-based businesses. And that has done quite well for us across sectors. So, I think, Farah, from our perspective, it's sort of business as usual, but I think certainly from LPs, I think you are going to see a retrenchment from EM the next 12 to 24 months.
Very interesting. And we are talking about emerging markets, but usually it's not great to look at it as a cohesive asset class because region by region things do differ quite a bit. And Maya, I want to come to you when we talk about the Middle East. At deNovo, you're looking at these M&A deals or cross-border deals with a focus on the Middle East. So walk us a little bit about how the investment landscape has changed in the Middle East through the recent years and where you're seeing opportunities come up.
Thank you, Farah. It's actually quite interesting because I've had spent the better part of the past 17 years now in the region, which I can't believe that much time has flown by. But if I think about my first years here versus currently, I'm seeing a huge transition in just the attractiveness of this part of the world as an investment destination rather than a source for private equity firms to come and gather funds. I think that was the history. In my old days here at Morgan Stanley, when I first moved over, a lot of the private equity firms would come and gather money, basically, from the sovereign wealth funds who were very keen to diversify away and invest internationally. What I'm seeing today and what I've been seeing over the past handful of years is a very interesting transition where many of these funds are now coming here and looking at this as an actual investment destination. With a lot of the regulatory changes that have taken place, with a lot of the changes to the laws and ability for companies to own 100% of businesses, the ability for companies to think about expanding and growing and not necessarily needing to be localized, if you will, the way that they used to be historically. And frankly, when you look at what's happening in the world around us, when you see Europe going through the period of recession that is going through, lack of growth that's happening over there, and you see the US in its bit of a volatility right now, private equity firms are thinking, looking at this region and saying, okay, there is real fundamental growth taking place over here, and that's where it becomes a very interesting destination. When you look at, for example, what has happened in Saudi over the past 5 years, I'd say, with MBS taking more and more of a leadership role in Saudi, I would call it the waking up of a sleepy giant. I mean, there's a huge economy, Saudi. And the fact is today is really open for business in a way that I haven't seen in my lifetime. And I think none of us have seen such a dramatic shift in the way that they're looking at attracting international capital, attracting FDIs, attracting private equity firms, attracting global strategics, et cetera. And the UAE clearly has been a leader in that transition and in that openness and that invitation. So when you look at these two big economies of the region, Saudi clearly being twice as large as the UAE, you have room for optimism, and you see a lot of these investors coming in, and with that evolving their way of looking at the region, the way they're looking at investments. I mean, I can maybe later talk about some specific examples, but it's actually quite interesting to see how much has changed.
Right, I want to stay with you here a little bit and even focus on the sovereign wealth funds and their roles in this transformation. How is that playing a role in what you do?
I think the sovereign wealth funds have actually been driving this transition. Again, private sovereign wealth funds historically were spending most of their capital investing and diversifying outside. I think what has changed quite dramatically is how much they're investing domestically. And they're investing domestically through a number of ways. Number one, they are IPOing their assets that they own, so they're actually sparing the the capital markets in a way that we haven't seen previously. Number two, they are becoming private equity firms in of their own rights. I mean, ADQ as an entity got set up a handful of years ago. They actually own about 90 of the government-owned assets in the UAE. And they're using them, each and every one of them is now being targeted to an IPO by having their own equity strategy being built and being acquisitive in their own rights. And then you look at the PIF, and the PIF has really spurred the investments into Saudi, into their own local economy, and they're now more transitioning towards investing with local family groups and local organizations, but also being, if you want, the catapult of taking these companies into a place that they can actually eventually IPO. And then the last point, which is actually quite interesting for sovereign wealth funds in the region, is they're becoming partners for private equity firms globally to come in and actually invest in the region. So for example, Mubadala funded $2 billion into Silver Lake in 2020, and then Silver Lake in turn in 2021 took a stake in G42, which is an AI-driven platform based in Abu Dhabi. Just recently we heard an announcement by InvestAD, which is a subsidiary of Mubadala as well through ADIC. And they've actually now entered into a JV with Blackstone to do a private credit fund in the UAE. Equally, we're finding other examples of Apollo, who came in and took a stake in Aldar. They've invested a Herculean $1.4 billion in 3 different tranches, $500 million into the investing entity of Aldar, about $500 million towards joint venturing on developments domestically in real estate, and then another $400 million or so into a structured instrument as well. So we're seeing these types of interesting partnerships and joint ventures that are being set up driven by the sovereign wealth funds, driven by the government-owned organizations over here as a way to get the know-how, to get the knowledge, and to get these organizations to come and to do more here. I've had the pleasure of being a chairman, non-executive for BlackRock for a couple of years, and BlackRock has led a consortium of $15.5 billion worth of an investment into the Aramco LNG pipeline. And in return now, the sovereign of the Kingdom of Saudi Arabia have now mandated BlackRock to manage $50 billion worth of its own assets into infrastructure investments into Saudi. So again, all of this stuff comes together in terms of how we bridge the gaps of knowledge and know-how in terms of developing and growing our own domestic economies.
Absolutely. Such an interesting ecosystem, and these are some amazing numbers. Thank you for sharing, Mai. And I'm going to pivot a little bit. We cannot talk about emerging markets without talking about Asia. And Sean, I come to you to tell us a little bit about some key developments in markets you look at in Asia, your key areas of focus, the main opportunities you see in Asia, but also even the main risks.
Yeah, thank you. So I've been investing in private equity and private debt in the region, actually globally for over 20 years. I spent 17 years of that in GIC, private equity department, which is one of the world's largest investor in both developed and emerging market. And in emerging market, every emerging market is different. When I was in GIC, I invested from Africa, Central Europe, Latin America, Asia Pacific. And different countries have its opportunities, different countries have its risks. For now, to me, the most exciting market is actually Southeast Asia, where I'm based. And the reason is because a lot of people might not know this, but there is a lot of fear about China, which has been leading the world's growth for many years. And now recently, people are pulling back from China. And where, if you want to pull back from China, where do you go to? You can't pull out of Asia. Asia is still going to be the driver of growth. So there are 2 other pockets of growth in Asia, and that's basically India and Southeast Asia. If Southeast Asia is an entity, you'll be the 3rd largest country in the world by population. You'll be the 5th largest in the world by GDP. And what's attractive about Southeast Asia is it has a young population. 60% of the population are aged under 35, fast-growing middle class, fast adoption of technologies. More people, on average, each household spend more than 3 hours online, more than the average American. So we have a lot of positive attributes in Southeast Asia, where you have, for a long time now, political stability, you have influx of capital. The number of family offices set up in Singapore has grown 5 times in the last 3 years. So a lot of wealth globally are coming into the region, and we are seeing a lot of opportunities. And to answer the question, to address the question on what's exciting, how do you address the risk in the current climate? The risk is high interest rate. High interest rate raises the cost of doing business, raises the required return, and the best way to tackle a high cost of capital is actually investing in higher growth companies. So the average GDP growth in ASEAN is actually 4 times higher than the average GDP growth in the world. So I personally like India and Southeast Asia. I have a slight preference towards Southeast Asia because in valuation, everything boils down to valuation. Valuation-wise, Southeast Asia has corrected together with China and India, but it is in the sweet spot. And the thing about Southeast Asia is it is a fairly neutral place for investors. So between US and China, American companies are being more cautious of investing in China. They are looking for a third alternative, and that's India and Southeast Asia. And it's likewise, China investors are being more cautious of investing in US, so now they are picking for emerging markets, India and Southeast Asia.
I will stay with you here. So you mentioned a little bit earlier, China. That is, the key word. Walk us a little bit about, in terms of your outlook on China. There are a lot of tensions between the US and China in terms of investments, curbs on investments. We've seen that with chips. How has that kind of deterred or not of investor appetite in the country?
Yeah, investor appetite has got reduced really, really sharply. I've never seen such huge reduction, such huge pull out of capital. So much so that people are asking whether or not China is investable. Wow. To me, China is always investable. China would for sure become the world's largest country by GDP. It is definitely on course to overtake US, and US is not going to let go of the fight without let go of the crown without putting up a fight. So there is geopolitical tension, unfortunately. Of course, my view is that peace will prevail, and my hope and the reason is because if the two giants fight, everybody else will suffer. So as long as there's peace, China and US will coexist peacefully. There will always be tension in the room, but you will both need each other. China is a huge buyer of US treasuries. The China savers have been financing US consumption, and the US consumers are buying goods made in China. So that will continue for a long time. So I think the pessimism in China is overblown because you have to invest in the world's largest economy. There's no choice if you want to have a diversified portfolio.
Right. And Elizabeth, I move on to you. You said how Asia is such a big part of what you do at KKR. Do you have that same view that you have to invest in China no matter what?
Yes, I think this goes back to the idea that, even within China, single economy, there's a lot of diversification in terms of what you can do. And unless you're an entity that's completely constrained from investing in China as a country, I think if you look at the more micro level, there's certainly a lot of opportunity around consumer behavior or technology that's not in sensitive sectors. So as an international firm like KKR, I think it is difficult for us and many other foreign investors to consider things like AI, machine learning, semiconductors. That's a subset of the economy that I think is difficult and perhaps uninvestable. But we have a really exciting China portfolio that has completely innocuous investments, if you will. For example, we have a pet food company that plays on the growing trend of pet ownership and dog ownership in China. So that's just an example of the fact that there can still be really interesting opportunities without this stigma of geopolitical concern.
Right. Very interesting. And now we're moving on to what I think will be my favorite part of this discussion, valuations. You're smiling, and Taimoor, we were just discussing it before the panel. As an investor, Taimoor, valuations correcting looks a little bit different than for you, Mai, as a seller. So walk us a little bit, how do you navigate that difference, Taimoor? As an investor, first of all, have valuations reset to a level where you think is interesting, where you think people can come in and buy?
I think it depends on the markets. It was announced last week. We just exited a business in India for 9x, an online travel business. Phenomenal exit. This company went through COVID for 2 years, and we were still able to do a 9x in that space because India is hot, has a great IPO market, etc. Other markets are very different. We were speaking, May and I before about Egypt. Given now what's happening with Egyptian FX, it's very difficult to decide, what are you buying and what percent, and how much longer is it going to go. So I think broadly, generally, I would say valuations are down, and we're a growth investor. We don't rely on leverage, but certainly people who are doing large LBOs, etc., can't find the debt to do those either. So that's also going to inherently, I think, bring down valuations. But I would say valuations have not come down as much as you perhaps think they have come down.
Okay, that's pretty interesting. From your standpoint, how does that look like?
So I am naturally biased. When we spend most of our time working on sell sides on behalf of our clients, clearly we try to do our best to keep the valuations as robust and as valuable as possible.
Right.
And I think one of the challenges that we've been facing in that is that because you're seeing Europe at a depressed level, because you're seeing some headwinds happening in the US as well to some extent, comps then become a little bit difficult for us to entirely rely upon, particularly when our region has experienced growth,
Right.
whether we're selling something in the consumer space as an example, or something in the energy space, or even the financial institution space, where we're seeing tremendous growth over here, but not so much so in the rest of the world. So it's always been an interesting challenge for us to try to make sure that we keep, if you will, the eye on the ball for the buyer universe on the fact that this is a growth market and that it does deserve a premium to what they might see elsewhere. So it's a bit of a, I don't want to call it a game, but it's sort of an art of a bid-ask spread. And clearly when you see a lot of transactions taking place, it does assure one that we are meeting buyer and seller somewhere in between to allow transactions to happen. Over the past few years alone, the private equity participation in this region has grown tremendously from about 9 billion or so in 2000 to double that in 2021 to equally around 20 billion more or less in 2022, and we're continuously seeing that trajectory continue to take place. So I think I'm fairly optimistic that we will find the right buyers for the right companies that are being sold.
I'm sure. I want to stick with a keyword. You said energy. We were just talking about sectors again before our panel started. And in the region, energy continues to be a key one. Walk us a little bit about how the energy transition has kind of has it dented investor appetite for these companies, or is that still here to stay?
No, what I find most interesting is that the biggest proponent, if you will, and biggest actor in energy transition is ADNOC. I mean, this is where I see this country take a real concerted global leadership role in driving the agenda around energy transition. And we do a lot of work with ADNOC. We're seeing the level of activity that they're doing, the level of acquisitions that they're doing, and investments that they're doing within that continuum of going from your traditional NOC to a real leader in energy transition. Equally, we're seeing a lot of that focus and attention in Saudi with Aramco. We heard that theme come up a lot at the FII last week. There's a tremendous amount of effort happening from this part of the world to show themselves to be champions of energy transition. I think they recognize that in several decades to come, we cannot continue to rely on oil. And if we don't champion the transition, we will be left behind. And so that whole diversification strategy, you can hold it part of being a good global citizen, but also part of actually ensuring your children's and your children's longevity and economic well-being. So I think the combination of those two themes have resulted in energy transition being a real serious topic that this part of the world is very actively focused on.
Yeah, absolutely. And Sean, you sort of look at things in a different lens. Technology is more prominent in Asia. Are these trends still strong? Are you seeing some transformation in terms of sectors that you're looking at?
So the energy transition is definitely a sector because there's a lot of renewable energy in Southeast Asia. There's a lot of trees. We are near the equator, so that helps. There's a lot of biomass, carbon credits is a growth area. But aside from, that's just one of the many growth areas in Southeast Asia. In Southeast Asia, the sectors that we focus on includes fintech. There are 290 million people. There's not underbanked in Southeast Asia, and they are accessing credit, many of them for the first time with the use of technology. So fintech is a huge growth area. We have, of course, the rising middle class consumption. That's a very, very powerful growth engine. We have people in Southeast Asia keeping pets too. So pets is one of the things that I look at, along with healthcare. Healthcare is severely underserved in the region, as lots of opportunities to use technology to jumpstart healthcare service provider. So there are so many high growth, independent growth drivers in the region. So our philosophy is we always invest in high growth markets and the leaders in each high growth markets. And I think the benefit that we bring is that in all these emerging markets, the key theme is that you have to invest alongside the locals. Because what a lot of people don't understand is that in a lot of emerging markets, it's the local tycoons, the local billionaires that controls much of the economy. So you need to be aligned with them because they are the locals. They made their money in their home geography. They know them best. So when we do deals, we are aligned with the local business leaders. Yeah.
Well, unfortunately, we are now at the end of our panel. We have run out of time, but this was super insightful. Thank you so much to our panelists, and thank you so much for listening in. And have a great evening.